I think one of the great dangers in the international monetary system today is actually stablecoins. To me, that's a ticking time bomb waiting to explode. But it would only take one fraud to start a panic in the market, basically a run on the bank. There is this narrative out there that foreign countries are dumping their treasuries and everyone's dumping the dollar and the BRICS are coming up with another currency and it's the end of the dollar and the Great Reset, et cetera, et cetera. None of that is true. The BRICS don't need a new currency. They already have one. It's gold. Gold will go to $10,000 an ounce. That seems to be an almost pedestrian prediction at this point. So that's going to happen a lot more quickly than people expect.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexej Jordanov, and in this format I invite you to look at the world through different lenses to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Welcome to the Macroscopic Podcast. Today, I have the honor of interviewing someone I actually wanted to interview since quite some time, Jim Rickards. Welcome to the podcast.
Thank you, Alex. It's great to be with you.
So the context here, Jim, is that we're inviting you to Amsterdam for the conference we're organizing of the 15th anniversary of GoldRepublic. And to give a bit of our audience a bit of context there, we thought it would be nice to record a small interview before that to also let people know about that. And we'll have a conference with also Peter Schiff that will be giving a keynote. You will be giving a keynote. We will also have before that some recordings with also Willem Middelkoop and Edin Mujagic, who are also going to be a part of the program, but in a Dutch-speaking program. And we will live stream this. So to all our audience, if you want to not miss that and you cannot attend physically, there's always a possibility to obviously join the live stream where the link is in the description down below. The question that I usually ask to first-time appearance guests on my podcast, which is the following: which is your most heretical thought about the monetary system today?
Well, heretical generally means outside the mainstream or something very different from the conventional wisdom. I would say that I'm very oriented to risk and things that can go wrong. It's great when things go right, and we look for that in our forecasting. But I'm always on the lookout, as we say, for things that can go wrong. I think one of the great dangers in the international monetary system today is actually stablecoins. And people are surprised to hear me say that because they say, well, the name itself, Stablecoins, isn't it stable? The answer is it's extremely unstable from a systemic point of view. Now, maybe I should just take a minute and explain for what a stablecoin is. It's a kind of cryptocurrency, but it's not meant to jump around in value like Bitcoin, it goes way up or way down. I'm not going to, guess where Bitcoin's going to go. But in a stablecoin, there'd be a sponsor, an issuer of the coin, and hypothetically you would give them $1 and they would give you 1 coin. Now, it can be any ratio you want. It can be any currency you want. But the idea is there's a certain unit of currency paid for a coin, and then it maintains that value. It doesn't go up or down. So if at some future point you want to get, in my example, want to get your dollar back, you contact the sponsor. There's probably an exchange or, just online, obviously, and you redeem your coin and get your dollar back. So very simple transaction. So let's look at that from the point of view of the user and also the point of view of the sponsor. So for the sponsor, it's fairly straightforward. They get the dollar, they issue the coin. The question is, what do they do with the dollar or $500 billion, which the market is kind of growing to that level? The answer is they invested in something. Now, if they're going to promise to redeem it pretty much on demand, dollar for dollar, they need to invest obviously in very liquid, very safe instruments. So typically, Treasury bills would be the instrument of choice. U.S. Treasury bills. That is one of the largest, safest, most liquid markets in the world. I've had many years' experience working at one of the investment banks that was a so-called primary dealer. That means you have permission to deal directly with the Fed. I talk to the Federal Reserve every day, so I know how that market works and how liquid that is. So you buy all these treasury bills, but here's the point. Treasury bills today have a yield close to 4%. It moves around a little bit, but it might be 3.5 percent or so, but close to 4%. But the stablecoin itself has no yield. So the person who buys the stablecoin gets the coin, but the sponsor gets the money and buys treasury bills and makes, my example on this is the market rate, 3 or 4%. Well, take that up to hundreds of millions or billions of dollars, and you can see that the sponsor is making an enormous amount of money with no risk. And this is an unregulated market, so your leverage can be as high as you want. At least banks can do something similar, although they have to pay interest on the deposits, and there are limits on risk and leverage in the stablecoin market. There are no limits, so you can have as I say, as much leverage as you want and make all that money and keep it. So and the costs are quite low, highly scalable business model. There's some costs, you need your servers and your processing centers and some other paraphernalia, but but not that expensive and completely scalable. Meaning, once you get that in place, you could take your issuance as high as you want. And of course, the leading stablecoin is Tether. Now, how does that look from the user's point of view, the person who puts in the dollar and gets the coin? Why would you take a token or a coin or whatever you want to call it that has no yield? Well, the answer is, and I'll use Tether as an example, but there are many of them at this point. Tether is the currency of choice in the crypto world. Most Tether are used to buy Bitcoin. And you say, well, why don't you just go buy Bitcoin? Well, the answer is you might want to sell the Bitcoin, buy another cryptocurrency. You might be in and out of several currencies. You might be in crypto world for a long time. So Tether is your currency, if you will, in crypto world. So first you buy the Tether, and then you use the Tether to buy the Bitcoin. And, good luck with your Bitcoin. You can make or lose a lot of money. That's fine. That's a separate issue. And then at some point you may want to sell your Bitcoin for Tether and then use the Tether, keep the Tether or use it for something else. So Tether is the currency in crypto world. Most of it, and by the way, this is all documented. These are not just hypotheticals, but most Bitcoin are purchased with Tether. So the user buys the Tether and can be used to buy Bitcoin. The sponsor gets the cash and buys treasury bills and makes a lot of money. So what's not to like? The sponsors make a lot of money, and the user gets a valuable currency that they can use to buy Bitcoin. So why do I say that this is perhaps the greatest threat to the international monetary system? The answer is, let's just look at some of the things that can go wrong. Now, there are many stablecoin sponsors. I have no doubt that almost all of them are very legitimate and they do exactly what we just described. But I would be shocked if there's not at least one fraud going on. In other words, what's to stop? There's no transparency in this market. There are no audits. There's really no accountability. So could a sponsor take the money, in my example, and just steal the money? The answer is yes. Has that happened yet? No, but human nature being what it is, it will happen sooner or later. Just think of FTX. Sam Bankman-Fried is in jail right now for running a major cryptocurrency fraud. So if that happens, and I expect it will, and again, I'm not pointing a finger at any stablecoin sponsor, and again, I'm sure they're mostly legitimate, but it would only take one fraud to start a panic in the market. Basically, a run on the bank, good old-fashioned run on the bank, the kind we've seen throughout history, where everyone races in and says, "I want my dollar back. Here's my stable coin, whichever one it was. I want my dollar back." Because this guy over here was a fraud, and I don't know who else is a fraud, and there is no transparency. There are no audits and so forth. So what happens then? Well, the sponsor, if they want to live up to their promise, is in the position of having to sell treasury bills, in my example, to get the dollars to pay back the people redeeming their coins. if they have treasury bills. A separate problem, even if you're not a fraud and you didn't steal the money, is it possible that you invested in commercial paper? Did you invest in equities? Did you invest in corporate bonds? Did you invest in some other instrument? Again, not a fraud, legitimate investment, but something that had a higher yield because you were greedy and you wanted something, with a higher yield than treasury bills. That's a possibility. In fact, there's some evidence for that. Tether settled a enforcement action from the New York State Attorney General, and in doing so, they offered the only thing I've seen, which was a pie chart of what they invested in. It was not an audit. It was not a balance sheet. It was a pie chart, but it showed that over 50% of the assets were invested in commercial paper, not treasury bills. Now, what is commercial paper? Sorry to get too legalistic, but this is where the problems arise. Commercial paper is an unsecured corporate IOU with a maturity of less than 1 year. So in theory, liquid, but just remember what happened in 2008. General Electric commercial paper froze up, and the Federal Reserve not only bailed out the banks and the money markets, but they had to bail out General Electric because that commercial paper became illiquid. So first problem is, did you steal the money? And I have no doubt that somebody did, even though most of the operators are perfectly honest. Second problem is, did you invest in the most liquid instruments or other instruments, in which case you might not be able to sell them fast enough to redeem? Or worse yet, you're selling them at a discount in a kind of fire sale environment where you're not even getting your dollar back because you have to sell it at a cheaper price because it's, as I say, it's a fire sale. And the buyer knows you're desperate, so they just offer a lower and lower price. The third problem is, even if you have treasury bills, that would be the best case where you really did buy the most liquid, safest instrument, and there's no fraud or chicanery going on. Again, I have many years of experience in the treasury market. It's big. It's not that big. You can't sell $100 billion of treasury bills overnight. You can sell 10 billion, that would be a big order, but 100 billion, no. So even the most liquid market can break down. So in this world, will there be, is there enormous leverage? Yes. Is everybody playing it straight? Almost certainly not. Most are, yes. I'm not disparaging anyone, but there's certainly a fraud out there. And even if you're not a fraud, you could be invested in illiquid instruments. And even if you're pristine, your hands are clean, you've invested 100% in U.S. Treasury bills, the market's big, but it's not that big in a panic situation. So my concern would be that, well, not just concern, I just from experience, this will happen. The market will freeze up, exactly what happened in money markets and commercial paper in 2008. The Fed will be very reluctant to bail it out. I mean, the Fed gets criticized when they bail out money market funds, because they're not banks. I mean, they bailing out banks is kind of their area of responsibility, but not money market funds. But they did bail out money market funds. Would they bail out the crypto equivalent of a money market fund? I'm not so sure. They might just let it fail as kind of a lesson. And then there you get into the issue of contagion, where a failure in one market very quickly leads to failures in other markets. Because if I'm the crypto holder, the stablecoin holder, and I redeem and I say, give me my money back, and you say, sorry, I can't, we're having difficulties right now, I may be desperate. I may sell something else. I may sell stocks or corporate bonds or other instruments just because I need the cash and I can't get it from my stablecoin. So this is called contagion, where distress in one part of the market spreads to another part of the market. By the way, the mathematics of financial contagion are exactly the same as real contagion, viruses and bacteria. There are mathematical models as to how they spread. We went through them all with COVID, of course, but they're long-standing models. The SCIR model, it's susceptible, exposed, infected, and recovered, or they leave out dead, but a lot of people die. You have to factor that in. But the math is the same. So you could be looking at a global monetary crisis triggered by a crisis in stablecoin, which is almost certain to happen because stablecoins, at the end of the day, they're unregulated money market funds. They work like money market funds, but there's no limit, there's no transparency, no audits, no limits on leverage, et cetera. So to me, that's a ticking time bomb waiting to explode.
Well, very good point. And actually, to that, I was seeing that last week, the Fed Governor Stephen Miran argued that the stablecoin market, that's now regulated under the Genius Act signed in July, would effectively be a new buyer of last resort for US debt. And that the White House explicitly said that the goal of this law would be to ensure that the US dollar status is enforced by having 100% of treasuries. And some could even argue that, yeah, well, this is kind of like a shadow quantitative easing. Or we could also say deputizing private companies like Circle in that case, or Tether, as you mentioned, to monetize the debts that foreign central banks refuse to buy.
Right. Well, let's remember who Stephen Moran is. He's the chairman of the Council of Economic Advisors, which is the president's advisory economic council. He works in the White House. He's also a member of the board of governors of the Federal Reserve. So, which I have no problem with. I mean, that's fine. He's very talented, but he is very close to the Trump administration. The Trump family are in the stablecoin business. And the Secretary of Commerce, Howard Lutnick, is a major holder investor in Tether. And Melania Trump has her own cryptocurrency. So I like Melania as a first lady, but, it's kind of a branding issue. So my point being, the Trump family are very invested in the business that we're talking about. And Moran himself works in the White House, very close to everyone we're talking about. So, query whether there's a conflict of interest there. When Moran says that the stablecoin industry, which is growing very rapidly, by the way, is, I wouldn't say a buyer of last resort, but just a buyer of treasury bills, and is going to hold those bills, and as provide liquidity to the treasury bill market. He's right about that. And so if you're assuming that all is well in stablecoin land, and you're the issue of treasury bills, it's probably nice to have a steady buyer out there. But I'm raising a different issue. I'm saying, what if all is not well in stablecoin land? That's what you're not hearing about from the White House.
There's also estimates that by 2030 it would be kind of the size of the Fed's pandemic era QE, so I think around 3 trillion by
Yeah, it's not
2030.
right. It's not. It's a good point, Alex. It's not exactly QE, because QE comes from the Federal Reserve. When the stablecoin industry buys a treasury bill, and you're right, they're buying enormous amounts. They're doing that with dollars that come from individuals. So that money comes from somewhere. It could come from commercial banks. It could come from savings, etc. It could come from the assets, of endowments or sovereign wealth funds want to buy it. I suppose they could. Some of them almost certainly are. But that money is in the system. It's not the same as the Fed. When the Fed does QE, what they do is, so you're the open market desk at the Federal Reserve Bank of New York, and you want to increase the money supply. This is base money, or M0. So what do? They call Goldman Sachs or Morgan Stanley or Citi, and they say, offer me 5-year notes or offer me treasury bills, whatever. And the dealing desk of the bank offers them. They say, done. The bank sends the bills or the notes to the Fed, and the Fed pays for it with money that comes out of thin air. So that's QE, because I'm buying securities, but I'm paying for it. When I pay for it, I just pull the money out of thin air, and that does increase the money supply. So that's what QE is. There are a whole lot of criticisms of that, but we can save that for another day. But the point is, when Tether, any stablecoin sponsor, Tether's the biggest, but when any stablecoin sponsor buys treasury bills or any treasury security, they don't create the money. The money's coming from real investors who are putting the money in. So, so it's not really QE, but you were right in the beginning when you said that this is a huge buyer and a source of stability in the U.S. Treasury bill market. Now, there's another problem if you really want to drill down, which is, okay, what if Tether is buying all these? Again, I'm picking on Tether, but I mean stablecoins generally. What if they're honest and they're buying all these treasury bills? And that's what we've been talking about. Well, that seems good. All these treasury bills are going into strong hands that, they're just on the balance sheet of the stablecoin issuer. They're piled up. They're rolled over, but they're not doing anything else. Okay. Well, let's talk about the biggest market in the world, and it's not the Treasury securities market, it's the derivatives market. And the estimated notional value is, according to the Bank for International Settlements, is $1 quadrillion. So for those not familiar with the Q word, the quadrillion is 1,000 trillion. So that's the notional value of all the derivatives in the world. So if I'm a derivatives trader, you're a hedge fund, I'm a bank or whatever, and I'm buying derivatives from you or vice versa. How is that transaction secured? How do we, we write a contract and I pay you fixed and receive floating or vice versa. Lots of ways of doing derivatives, but how do we secure the performance of the contract? Well, the answer is I give you some margin, just a little sliver, a little bit of initial margin. And you say, okay, thanks, Jim. I got your margin. By the way, if you lose money on the trade, I'm going to call you for some more. And I say, okay, fine. I understand that. So we have back office margin desks and the margin money moves back and forth. But what is the margin? What security will you accept from me as margin? Well, in good times when everyone's feeling good, it could be mortgages, corporate bonds, could be all kinds of stuff. But in times of distress or in times of tight money or in times of recession, you're like, sorry, Jim, I don't want your dumb mortgages. I don't want your corporate bonds. I want Treasury bills. And Treasury bills are the best, most liquid collateral in the derivatives market. Now, and so if Treasury bill issuance is being reduced or the supply is drying up or Treasury moves out the yield curve and wants to issue 2-year notes or 5-year notes, et cetera, or stablecoins buy $500 billion or $1 trillion of Treasury notes, where are the Treasury notes coming from to act as collateral in the derivatives market? In other words, the derivatives market depends on a ready supply of highly liquid, safe Treasury bills. If the stablecoins buy them up, where are the banks and dealers going to get the bills to secure the derivatives market? Well, if they can't, they're going to reduce their balance. These are off-balance sheet products, but they're going to reduce their books. They're going to say, well, sorry, times are hard, money's tight. If I can't get Treasury bills from you, I'm not going to do the deal. And you start to shrink the $1 quadrillion derivatives market, which is another source of stress. So this is a very complex system. There are a lot of linkages. And the problem I see, Alex, and we've kind of been talking about it, people look at one slice like, oh, stablecoins, all good. I buy Treasury bills and make a lot of money. Or derivatives, all good. I give you Treasury bills as collateral. Call me if you need more, et cetera. But everyone's relying on this Treasury bill market to keep the wheels in motion. And the minute there's a problem, and I guarantee there will be a problem, don't know where or when, but it always comes, and there's a panic and everybody wants their money back, all of a sudden you find that the Treasury bill market is not big enough or not liquid enough to give everybody their money back, and then you get into catastrophic failure.
That's a very good point.
And by the way, sorry to interrupt. These are all good reasons to have gold. Physical gold doesn't have any of the problems we've been talking about. So I'm describing you have to be fairly knowledgeable, or at least, kind of follow the thread to understand where these dangers come from. They're there. But when I look at them, I say, yeah, I understand it. And to me, it's a reason to own some physical gold.
So we'll get to gold in a bit, but I just want to maybe have one more, let's say, follow-up question on that part. If there's so much demand as well on the treasuries, and it's a very good point that you were mentioning that this demand cannot be soaked up if it's actually coming back on the supply side, in case of like a stressed liquidity crisis or some form of that. But it will decrease eventually the interest rates, the treasury rates, right? And
Yes.
and thereby making it more aligned to what also the administration is aiming at, I guess. But
Right.
on the other hand as well, and we haven't talked about this, there's kind of like a bit of a CBDC aspect to it, meaning that they will be able to seize, freeze, or burn those assets when legally required. So it's kind of just an overextension of a global CBDC in a way, if you hold a stablecoin that's in Europe and Asia or whatever, and are basically under the whim of whatever you might be doing right or wrong, and being seized your assets or your stablecoins based on certain things that you do or you don't do. So that's also, let's say, maybe a first step in stone of a CBDC like Trojan horse system. one might say. And you've talked
Yeah.
extensively about that in the War of Cash.
Right. I agree with that completely. All these crypto groupies and, crypto cultists, whatever, they're always talking about anonymity. They can't find me. They don't know who I am, etc. That's nonsense. There's a certain measure of anonymity, but I've done work with the U.S. Special Operations Command based in Tampa, Florida, when we were fighting ISIS. And ISIS had two forms of money. They had Bitcoin and gold. They had the gold dinar, the caliph and the gold dinar, etc. But their other form of money was Bitcoin. So I was working on sort of cracking that and tracking that. And with the right forensics, it's easier to do than you think. The thing about Bitcoin is, well, any cryptocurrency, but my particular experience was with Bitcoin. There's the blockchain. Now, the blockchain, when you look at it, it doesn't have the name of the person. That's correct. But it has every single transaction with an identification number. So even if you don't know the person's name, you can, if you take the number as a starting place, you can see every single transaction they did and every counterparty also by number that they interacted with. That's an interesting topic in and of itself. So all you need to do is really use forensics or interrogation or pocket litter or something to associate with the name. And the minute you have that, you have every transaction that person ever did. So I wouldn't take too much comfort from so-called anonymity. But beyond that, most, they say we'll get a cold wallet or whatever. Yeah, sounds good, but most people don't do that. They work on exchanges, and particularly with stable coins, they pretty much have to go through some exchange or the stable coin system operator. Well, it's very easy for the government just to get those records. You just subpoena them. You need at least under U.S. law, but in general, even with other jurisdictions, you need some probable cause or some reason or some predicate. But that's not a very high hurdle. In communist countries like China, you don't even need that. You just go take it. So, governments can very quickly get to these records. And by the way, what we're talking about, the major power that avoided this problem, at least to some extent, and may have saved their economy, was Russia, because Elvira Nabiullina is the head of the Central Bank of Russia. I like to say she's the only central banker in the world who actually understands her job. She's done it very well. But going back as early as 2014, she had invested 25% of Russia's reserve position in physical gold bullion. So they had a lot of treasury bills, which turns out to have been a mistake, but they did. But they had their reserves in, well, I'll come forward to 2021. They had about $600 billion in reserves. 150 billion of that was in physical gold bullion stored in Russia. The other 450 billion was in other instruments, mostly U.S. Treasury securities, kept at Euroclear, which is a depository in Belgium. So when the special military operation commenced in February 2022, the United States immediately froze all the Russian assets we could find, including about $200 billion of Treasury securities in Euroclear, and they're still frozen. And now this Ursula von der Leyen, the kind of crazy head of the European Union, she's working on some cockamamie deal that she wants to organize a loan to Ukraine. The loan would be repaid from reparations when Russia loses the war, but the loan would be collateralized by the $200 billion of Russian securities sitting in Euroclear. The reason this is crazy, completely illegal, by the way, but the reason this is crazy is because Russia's winning the war. Russia's not going to lose. Russia's not going to pay reparations. If anything, they'll take reparations from Ukraine. The loan will go into default. You have to turn to the collateral. And if they take it, that's outright theft. Now, what could Russia do in response? Well, they could sue Euroclear for wrongful conversion of the Russian securities. Now, Euroclear has offices all over the world. You don't have to go to Belgium. You can go to Hong Kong or Dubai. In other words, you could find a very friendly jurisdiction from the Russian perspective. Euroclear has $47 trillion of assets in custody. 47 trillion. Now, imagine Russia going into a friendly court in Hong Kong, which is controlled by the Communist Chinese, by the way, and getting an order freezing Euroclear assets all over the world. to repay Russia for the theft of the $200 billion of Treasury securities. So now you've frozen $47 trillion of assets, or at least put a cloud on them, because no holder would know if his or her particular assets were subject to the Russian freeze. My point is, von der Leyen, she seems to struggle to think one move ahead, but I just gave you a scenario of thinking 5 moves ahead, and shows you that it ends in another global monetary crisis. So I would say that you don't get anonymity. You're very exposed to government scrutiny. And by the way, the big winner is turning out to be Russia, because by threatening the $200 billion of Treasury securities, which they've done, we just explained that, it makes the rest of the world want to buy gold. Because if you're Saudi Arabia or Taiwan or Iran or Turkey or Mexico or anybody else, you're watching this, or Brazil, say, and you're watching this and you're saying, gee, what if the United States doesn't like what I do? How do I know if they're going to freeze my Treasury securities? And maybe they will. So I better get some gold, because that they can't freeze. Now, so as applied to Russia, they actually had the gold. They thought about this in advance. You know, the national sport of Russia is chess, so they're very good at thinking ahead. But Russia has made $150 billion of mark-to-market profits on the run-up in the price of gold. So the point is, by threatening to steal the securities, they created a demand for gold, which Russia has profited from, because they had $150 billion of gold to begin with, and if you double the price, which it has, you have $150 billion of mark-to-market profits. So Russia has made almost all their money back in terms of the price of gold. And other countries, other central banks are buying gold. So again, a good example of how this is a very complex, deeply interconnected network, and you can't just think of one thing. Oh, I've got my stablecoins, I'm all good. It's like, no, the government's watching. They can get the records. There could be a panic. You might not get your money back. And oh, by the way, if you're going to run around stealing assets like the United States and the EU, maybe it's a good idea to have gold.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, security saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. A good point. And on that line, I was also curious to have your take on what we already talked about Stephen Mira, who also is the author of the Mar-A-Lago Accord that was inspired by the Plaza Accord. And there was a bit of this plan to trade U.S. security guarantees for supply chain submission, and it's a bit of a like, we will protect you, but only if you buy our copper and sell us your lithium kind of thing.
Right.
Is this then the weaponization of alliance structures that you've predicted for many years, and does it force then the rest of the world to actually choose a side between the U.S. military and the Chinese market?
By the way, do you know who invented the phrase Mar-a-Lago Accord?
No, tell me.
I did. If
Okay.
you well, no, seriously, if you look at my book Aftermath, it's one of my books, came out in 2019, and chapter 6 is called the Mar-a-Lago Accord.
Wow.
So I'm flattered that Stephen Moran picked it up in November 2024 when his paper came out. He does use the phrase Mar-a-Lago Accord, and you're absolutely right about that, Alex. But I was the first one to use it 6 years ago, so my readers were 6 years ahead of the debate. But you're right. Yeah, getting to Stephen Moran. So he starts out talking about trade. And tariffs and the use of tariffs, etc. And I agree with that part of his analysis. But I also said in my book, Currency Wars, which came out in 2011, I said currency wars don't always happen. Sometimes they do. And I explained the history of those and the mechanics. But I said currency wars can lead very quickly to trade wars, or vice versa. Trade wars can lead to currency wars. And that's what's happened. And Moran talks about that. So he starts out with tariffs. Then he looks at all the U.S. trading partners and says, well, by the way, the easiest way for me to beat a tariff is by cheapening my currency. So let's say you and I are trading partners, and you put a tariff on my goods. So my goods are 100, it could be 100 million, whatever, just say 100, and you throw a 20% tariff on us. And now the goods are 120 at the point of entry because you put a 20% tariff on me. Well, if I turn around and devalue my currency by, let's say, 15%, I lower all my input costs. I pay my workers less. I do whatever I have to do, but basically I devalue my currency. So my workers are getting the same amount of local currency. It's not worth as much, but too bad. But I've lowered my cost to a currency devaluation, and that offsets the impact of your tariff. So, and life goes on. And Moran says to U.S. trading partners, don't you dare cheapen your currencies. We are not going to let the impact of the trade tariffs be diluted by currency devaluations. Okay, so the math is pretty simple, and we understand the threat. So you turn to Stephen Moran, and this is where the Mar-a-Lago Accord comes in, and we say, well, okay, I hear you, but how are you going to enforce that? What's your enforcement mechanism? How are you going to back that up? And here, I think he goes out of his lane, and maybe gets a little over his skis, and starts talking about military policy and nuclear warfighting. I'm like, wait a second, I thought you were an economist, but that's okay. And what he says is that we're going to have a system of green, yellow, and red. Now, I call it the traffic light because, around the world, certainly in the U.S., traffic lights are green, yellow, and red. But he doesn't use the phrase traffic light, but he does say green, yellow, red. So what's green? Green means you're a good friend of the United States. We put some tariffs on you, but you've accepted them. You're not cheapening your currency. You're a good trading partner. You're a good ally. And by the way, we will extend U.S. Security protection and by implication, the U.S. nuclear umbrella to you and defend you against your enemies, back you up, etc., because you're a good trading partner. Yellow means you're okay. You're not an enemy, but you're not doing everything we want. You're complaining about tariffs. You're putting on countervailing tariffs. You're trying to cheapen your currency a little bit. We'll trade with you, but you're not our best friend, and maybe we'll help you, maybe we won't if you get in trouble on the security side, but maybe not. Red, you're an enemy, you're an adversary, and we're going to put the highest tariffs on you. You're not going to get any consideration. If you cheapen your currency, go for it. We'll just raise the tariffs, and not only will we not defend you, we might be in military operations against you, regime change or whatever. So that's green, yellow, red. Now, again, bear in mind, we're talking about an economist who's on the Federal Reserve Board talking about nuclear warfighting. So I query whether, now, Henry Kissinger could do this. He had the talent. James Baker could do it in 1985 at the Plaza Accord. Steve Moran's a smart guy, wrote a good paper, but I don't quite put him in that same category. So, but that is what he discusses in his paper, and that is what goes under the heading of the Mar-a-Lago Accord today. So you pretty much have to be an economic expert, a trade expert, and a foreign policy expert to absorb or comprehend everything he's saying. But I recommend the paper. It came out in November 2024. It's available online. It was before before Trump won the election and before Moran was in the White House. But that paper is out there, and it is one of the blueprints for Trump administration economic policy.
Yeah, as you said, you've been covering this for years. So also, I wanted to pick your brain on the one big beautiful bill that was signed in July, and also the role that it would actually take into saving kind of the U.S. dollar. This 150 trillion mineral endowment that you also talked about. Is this maybe like a move that we see from the U.S. to still save the dollar by backing it with copper, silver, and oil on the ground?
The answer is yes. I don't think the dollar is in any distress, by the way, and we'll talk about this in Amsterdam. Looking forward to it. But there is this narrative out there that, foreign countries are dumping their treasuries and everyone's dumping the dollar, and the BRICS are coming up with another currency, and it's the end of the dollar and the Great Reset, et cetera, et cetera. None of that is true. There are big things going on. We've talked about some of them in this call, and they're important, and we'll talk about them at your 15th anniversary conference. But the idea that the dollar is crashing or something is not true, and that's not just an opinion. There's a lot of data to back that up. The U.S. Treasury issues a monthly report in spreadsheet form showing all the major countries and all the reserve positions and how many treasuries they own, etc. They're not going down. They're pretty constant lately. If you do see any sales of treasuries, it's not the case that the seller is dumping treasuries. It's the case that they actually wish they had more, and they're desperately short of dollars. And there's a lot of people get confused. They say, well, the dollar is the leading global reserve currency. Well, in a sense, but central banks and finance ministries do not hold reserves in dollars. They don't have pallets of $100 bills, in the basement of the central bank. They buy securities. Now, the securities are denominated in dollars. That's true, but they actually have securities. They have treasury bills or notes. We've been talking about. So if they sell some, it's not that they're dumping them; it's that they're desperate for cash. Why would a country like China need cash? The answer is to prop up their currency and prop up their banks because they're in a emerging liquidity crisis. So in general, are countries selling treasuries? The answer is no, and that's borne out by the tick reports that come out monthly from the Treasury. But if you do see a reduction, that's not a sign of fear of the dollar. That's a sign of desperation. They wish they had more dollars, but they need cash to prop up their banks and prop up their currencies. So that's kind of the big picture in terms of the dollars. And as far as the BRICS are concerned, the BRICS are not coming up with a new currency. They are implementing new payment systems, payment channels, or what are called rails, with their own proprietary cables and clearinghouses. Yes, they're very far along in that, and it's important. But that's all technological development. But they're not running a new currency down those rails. They might be using yuan or rubles or Brazilian reais or U.S. dollars for that matter. They just want to get outside the SWIFT system and Fedwire and automated clearinghouse and other dollar-based systems where they're more vulnerable to freezes and so forth. But my point is, the BRICS don't need a new currency. They already have one. It's gold. In other words, if you're China and I'm Russia, and I'm selling you natural resources and you pay me in yuan, and I'm buying manufactured goods from you and I'm paying you in rubles, we build up these ruble yuan balances. Or there are, think about 12 or 13 members of the BRICS right now, and there's a waiting list of 20. So there are more countries in that trading network and potential currency network, including Brazil and India and others. But just take a simple bilateral relationship between Russia and China. Okay, so you've got a bunch of rubles and I've got a bunch of yuan. How do we settle that up? Well, a couple things. Number one, you don't have to settle it up in real time. You can do it quarterly or twice a year, et cetera. The central banks can basically redeem or provide liquidity to the importers and the exporters. So the individual actors in their countries can deal with the central bank. The central banks themselves have to deal with each other. So number one, it's not real-time settlement. It can be done, I guess, say quarterly. And number two, it doesn't have to be done on a gross basis. It can be done on a net basis, meaning I owe you something, you owe me something. Just net them out. One of us owes the other on net, but that net is a much smaller number than the gross payments. So settle quarterly on net, and we can settle in gold, and we're all square, and we move on. So you don't actually need dollars, but my point is, you don't need another currency either. You just need gold, and that system is already in extent to some extent. And again, physical gold can't be traced. I just put it on a plane and fly it over to your vault, or you fly it over to my vault, but no one knows it's moving unless you're very good intelligence operations. So the point being, there are no serious threats to U.S. dollar right now. If anything, there's a shortage of dollars. There could be a liquidity crisis, but that won't come from too many dollars or dumping dollars. It'll come from too few dollars and tight money, really not driven by the central banks at all, but driven by the commercial banks. But getting back to the asset side, so everyone, I'm sure we'll see this in Amsterdam, people banging the table. The U.S. is $38 trillion in debt, $38 trillion. Ooh, it's a big number, boogeyman, et cetera. That kind of analysis is superficial, even trivial, because you can't think intelligently about the debt unless you think about the resources, the income, and the assets available to pay the debt. And this is where you can't just focus on the liability side of the balance sheet, which is 38 trillion of debt. You have to look at the asset side. So what does the U.S. have in assets? No one knows, but we've used $150 trillion as an estimate. It's probably higher than that. We've used $150 trillion as an estimate. It's probably higher than that, but let's just take 150 trillion. Well, for beginners, it's more than three times the debt. Now, people say, "Oh, are you going to sell the Grand Canyon? Are you going to sell Yosemite Park?" No, we're not going to sell any national parks. We're not going to sell any national treasures. But under like desert land or plains, you have oil drilling rights, natural gas drilling rights, mineral rights, exploration rights, rare earths, lithium, gold, silver, copper, cobalt, etc. Not to mention drilling, offshore drilling, East Coast, West Coast, Alaska, the Gulf of America. All of that can be expanded. And then you have intangible assets. You have intellectual property. The U.S. has done an awful job of monetizing and licensing its intellectual property. And Scott Bessent, our Treasury Secretary, has talked about this. So do we have a lot of debt? Yes. Is it too high and should we be getting it down? Yes, I don't dispute that. It's not going away. We're not going to pay off the debt. Last time the United States paid off its debt was 1836. President Andrew Jackson did it, but that was almost 200 years ago. But that's not required. You don't have to pay off the debt. You just have to roll it over and make it sustainable. And the way to do that is by reducing the debt to GDP ratio, which again we'll talk about at the conference. And that's very straightforward. This is trivial math to keep your deficits below 3% of GDP. You get your surplus, your budget surplus at about 3% of GDP real, and then 2% inflation is 5% nominal. So as soon as you grow your economy faster than the debt's growing, your debt to GDP ratio goes down. That's all the market needs to see. So the dollar is solid. There's no replacement currency on the horizon, but there is one that the BRICS are using, which is gold.
And we'll talk about gold in the question in a few minutes. But first, I would like to stick to the topic and talk about so-called Silver Singularity. The fact that on November 7th, we had the USGS, the United States Geological Survey, who officially added silver to the critical mineral list. So this makes kind of silver miners eligible for the OBBBA's a 250 billion loan program, if I'm not mistaken. And I wanted to know from you, does this make silver or create the decoupling from silver to gold? Are we moving into an era where silver is priced as a strategic military asset rather than a monetary metal?
Well, silver has always performed both functions. Now, you're right, Alex. The role of silver and its designation as you describe it as a strategic asset is new. But silver has always been an industrial input, and that's why it's more difficult to analyze silver than gold. Gold actually is not good for very much, except it's the best form of money. So that's what we've been talking about. But the industrial applications of gold are quite few. I visited some of the biggest refineries in the world. I asked them, they make 4 nines gold, 99.99% pure gold. I've seen the electrodes. I see how they do it, and I guess I say I've been in all the refineries. And I asked one of the biggest refineries in Switzerland, their top guy, I said, "Can you make 5 nines?" And he said, "Yes." It's more expensive than gold. It's extremely expensive to do. It's more expensive than the gold itself. But we do it for certain kinds of wires, like ultra-thin wires. But that's not that common, coating for space helmets. It's got a few uses, but not that many. Silver is different. Silver is used in a lot of applications, automobiles, electronics, and other weapon systems and so forth. So gold is pretty much just a precious metal. Silver is a precious metal, but it's also an industrial input. So when you're trying to forecast the price of silver, you have to think of both factors. We could be in a situation where the economy is going into recession, so the industrial input side goes down a little bit, but the precious metal side is going up. Or you could be in a situation where both of them are going up because of new, U.S. rearmament and new weapon systems. The U.S. we gave all the junk, we gave all the stuff in the junkyard to Ukraine, but now we're going to build some good weapons for ourselves, and silver is an input to that. So, yes, I think look, there's no. I would say gold will go to $10,000 an ounce. I think everyone says that. I've said it for a while, but okay, fine. That seems to be an almost pedestrian prediction at this point. But where I think I stand apart is I will say that it's going to go to $10,000 an ounce much faster than people realize. That's going to happen a lot more quickly than people expect. But there's no way that gold goes to $10,000 an ounce. The silver doesn't go to $100 or $200 an ounce. No, silver is along for the ride. You're not going to see the kind of price increases I expect in gold without similar price increases in silver.
What effect do you think, because of that also, like we just talked about, on the paper market?
People ask me all the time, well, what's going to happen with the dollar? Is it going up or going down? And, as a trained lawyer, I answer your question with a question, which is, you ask me if the dollar is going up or down, and my answer is compared to what? In other words, on a given day, the dollar could be up against the yen, up against sterling, down against the euro, down against the franc, and down against gold. And the dollar can be up or down at the same time, depending on what your metric is. How are you measuring the dollar? I use gold because the currency, the euro US dollar cross rate is the most liquid, most heavily traded cross rate in the world. And there are a bunch of others, francs and Swiss francs and sterling and so forth, yen, of course, but they stay with it, and they can be up or down. If you're a currency trader, that's really important to you. I understand that, or an investor. But to me, they're all passengers in the same lifeboat. I mean, again, they can change seats, but they're all in the same lifeboat. They're going to kind of sink or swim together. The only objective measure of currency value is gold, because gold's not a currency. It is a store of wealth. It is a form of money, but it's not a currency, and therefore it performs a more objective function. So when I see gold go from $2,000 an ounce to $4,000 an ounce, which it has fairly quickly, I say, well, gold is gold. I mean, it's atomic number 79. It's an element. If you put a gold coin in a drawer, come back a year later, you still have a gold coin. Nothing changed. What really happened when gold doubles in price, what really happens is the currency declined 50% measured by weight of gold. So if you say, where's the dollar collapse, you won't see it in the euro. You won't see it in the Treasury market. You won't see it in the banking system. You see it in the price of gold. And that's the real reset.
Jim, well, it's been a real pleasure to have this first episode with you, and I'm really looking forward to more conversation that we will record in person, because I think it's also always better than online, and also spend time with you, getting to know you. So thanks a lot for that, and again, for the subscribers and the non-subscribers especially, please make sure to subscribe to actually not miss the videos we will release with Peter Schiff, Jim Rickards, but also Willem Middelkoop and Edin Mujagic. Jim, thanks a lot for your time.
Thanks.